Have you ever wondered where you should be thinking about taking profits when it comes to your Injective investments? If so, you're in luck because today I'm going to be sharing just that. I'm going to be looking at the charts, sharing my thoughts and opinions on where I would be looking to lock in profits when it comes to my Injective investments. As I get into this, smash a like button, subscribe if you're new, and let's jump right into the charts and take a look at what's going on with Injective. Okay, so here we have Injective paired up with USDT. We're on the 1-day Binance chart. And well, we've got some really interesting things going on. Obviously, we've had a really good run into this bullish market so far. Okay, we can see here that Injective has climbed up very steadily since July of 2022. This run so far has been an incredible 4,619%. Everything from, late 2022 into kind of 2023 and of course 2024, at least the early stages of it. So this is a very good chart to kind of get a good indication as to kind of where things could be going. Now, obviously, hopefully you have already checked out my price prediction video. If you haven't, I'll link it in the video here somewhere as well, so you guys can check that out. Now, what we want to do is we want to take a look at this through a couple of different points of view perspectives, right? We want to kind of have a strategy here, at least I do, of kind of dollar cost averaging out of the market like we would have dollar cost averaged into the market, right? And in order to help us with this, I'm going to be using a Fibonacci retracement tool. Again, this is a tool that is widely used by traders, and it has a way to kind of resonate incredibly well from a psychological standpoint with retail investors as well. So you tend to find that price likes to react to these Fibonacci levels when it comes to kind of, dropping down in a bear market or even rallying in a bullish market. And here you can see, and as I've kind of have been through this many times before, as I pull this across, you can see how previous areas of support were found and areas of resistance are found, more support levels, more resistances, and you can see that this is a common occurrence all the way through the chart. Okay, so this is really important that we understand, how the market is behaving in relationship to the Fibonacci. Now, if we go ahead and grab this and move it over to our bear market low point, this is what's going to help us understand where our kind of take profit levels need to be. So we have a low on the 13th of July, that was $1.12, and we have a low over here on the 18th, that was $1.13. So it's the $1.12 on the 13th of July that was actually the lowest. So we're going to go ahead and just pull this up, and I'm going to try to snap this right onto there, and that's actually coming in at 113. I need to put it down to 112. There we go. Okay, so now that we have the Fibonacci retracement tool actually put onto the chart here, we can now see how the price action has been behaving. Now, because this video is coming out a lot later than maybe you would have been thinking about, and maybe you've been taking profits, this is going to be a very interesting kind of take, because actually we should have been locking in profits on this one much earlier. So I'm going to pull this across to the right hand side here so that we can take a look as to kind of where the price action has been so far. Okay, so as we kind of think about this, as we kind of think about dollar cost averaging out of the market, we want to kind of approach this with the idea that we want to lock in profits gradually and slowly over time, but obviously still hold a significant amount of the portfolio position for those higher price targets. Now, our bullish target ranges, again, you can check out the actual price prediction video for more detail on this. It's going to range right in here between 157 and 507. Now, of course, in that, there's going to be some other key areas that we want to focus on. And I'm going to just highlight these right now, right into these little yellow box areas. Specifically around these key Fibonacci areas, and then I'm going to go ahead and communicate with you guys why these are important. Okay, so these are the first kind of three kind of key milestones that we would have seen, although we could have argued maybe a little bit earlier on as well. So depending on kind of how risk adverse you wanted to be, whether you wanted to kind of hold for kind of longer term or anything like that, it depends as to whether or not you would have kind of taken profit around this $3.61. Okay, but nonetheless, this will be the approach that I generally try to have. I'd look for around about 5 different ways to exit the market, or 5 different price points to exit typically. Sometimes it doesn't always work out that way, and in this particular case, I would say that actually there were 3 kind of key ranges that we would have been looking to kind of dollar cost average out of the market. Okay, so we would have had this first area down here. Now, in this particular case, this would have been between $7.44 and $13.33. Okay, this would have been an area that I would have been potentially looking to lock in about probably 20% of the portfolio. So I would have been looking to liquidate 20% of my position at this key area. This would have been a significant amount of surge to the upside from our July 2022 lows, coming in here at $2.12. I'm going to go ahead and pull that onto $2.12 there. We would have seen that this would have been a 500 to 1,000%. So you're talking 5 to 10x, and you would have been looking to lock in about 20% of your portfolio at those particular stages. In fact, I'm just going to go ahead and drop this on here so that I have this for future reference as well. Then, of course, the next kind of key range is the one that we saw most recently in early 2024. And here we would have been looking between $23 and $54 as a next area for taking profit. Again, this would have been a pretty hefty area. I probably would have been looking to lock in about 30% of what my portfolio was originally. Okay, that means that in this particular area right here, we would have been looking to lock in about 50% of our portfolio positions. Okay, and again, if we take a look at that, right, an initial kind of 5 to 10x, but up here, this was a 20 to 50x. It's actually just a little bit less than that, about 48x, right? So you can see that the potential here was very, very lucrative for this. Of course, this doesn't necessarily help you guys right now, unless, of course, you have been locking in those profits as we've kind of progressed through. However, one of the things that I like to do, and one of the things about this particular strategy that I really like, is that we have the ability to double dip. Okay, so although down here we might have been thinking if we had a retracement to the lower side, so if we had come back down here, revisited this from this range, then we would have been looking to buy up here and then looking for that next run to the upside. In this particular case, if we had locked in the profits here, say 48x at that $54 range, well, we could have now been accumulating on that next Fibonacci level. Okay, so that 30% that we had sold, we could have been buying in a dollar cost averaging strategy here for the next run to the upside, allowing us to basically sell once again once it got back to $54. Now, in that particular example, okay, let me go ahead and I need to stop deleting this one off the chart. So I'm going to go and put that in and leave it there. But in this particular example, we would have been looking for, $13 buy and then another push up towards $54. It would have been 311% extra on top of the 48x's that we would have already made on that 30%. So the double dipping element here can be very, very lucrative. However, it also comes with risk. Okay, so in this particular case here, considering we still have further targets to go for, and I do believe that they are highly probable targets, that would have been an okay thing to do. Typically, though, the higher that we go in terms of these targets getting hit, we don't typically want to double dip later in the game. Double dipping early is fine, double dipping later, not so much. So the next set of targets, and there's a couple things that you could kind of look at here. We could target out this one at $88, or we can just be thinking, okay, we've got 50% and it's going to be somewhere between 157 and 500. Now, it's really hard for the technical analysis at this stage to tell you exactly what we should do within this range, but you're going to be looking at that 50% and thinking that this is where you want to do it. So you might think, okay, well, let's start with 20% down at the low side at $157, and then maybe as we push up a little bit higher, we'll liquidate another 20%. That's a really bad too, my apologies. And then we'll ride the final 10% a little bit higher. This again comes in at your last 50% of your position, right? So let's kind of break that down. Obviously, it's a little bit hard to know exactly what that might mean, but if we go for the low side initially, that's about 142x position. That's a 14.2,000% move. Okay, and then the next one might be around the kind of $200 level, maybe a little bit higher than that, maybe let's say $250. That would be a 220.5x position, right? So 225x position, 22,500% move to the upside. That will be your next kind of 20% move, hypothetically. And then maybe you leave 10% to see if you can actually push out towards that 450 kind of X position at around $500. Okay, so you can see here that the gains on, Injective have been insane, right? We can see that we want to be locking in profits, but I still see this one actually having further potential in this bullish market. So we have seen great gains so far. We potentially are looking at maybe be double dipping if we haven't already dollar cost averaged, because, you know, we've kind of seen $13 getting re-hit again. We could be looking to capture another 300%, but ultimately locking in that 50% at this point would have been probably a decent-ish thing to do, with the 50% remaining, riding it out to those higher ranges between $157 and $500, taking a look at maybe $150 locking in 20%, $250 locking in another 20%, and if we hit 500, you can liquidate that final 10%. In this particular strategy, what it allows you to do is it allows you to lock in gains as the price action goes north, right? You don't want to be holding 100% on the hope that you hit $500, because what if it only hits 480, never hits your sell order, and well, you then start riding it all the way back down into a bear market? That's never a great feeling. So locking in profits on the journey, on the way to the upside, dollar cost averaging out of the market like you would dollar cost average into the market is typically the safer way to go, at least in my humble opinion. Of course, guys, this is just my thoughts and opinions on the data in the charts as I see it. What do you think? You can let me know in the comments down below, or better still, join us in our free Discord server away from all the scammers operating in the comments section. If you found this useful and informative, smash the like button. The more likes there are, the more people will get to see this, so you can spread the word on this kind of strategy. And of course, subscribe if you want to stay up to date with absolutely everything that we do here on the channel. And of course, as I said earlier, if you haven't checked out the price prediction video, well, it's that one right there, and it's one you probably don't want to miss.